Part 1. The stock market has a strange way of rewarding discipline and punishing excitement. Most people enter the market believing they are about to make quick money. They watch a few viral videos, read a few social media posts, and suddenly feel confident enough to compete in one of the most competitive arenas on earth. But the reality of the market is far less forgiving. Behind every sudden rise in price, behind every dramatic crash, there are forces at work that most retail investors never truly understand. The truth is simple but uncomfortable. The market does not reward intelligence alone. It rewards patience, structure, and rules that are followed with almost mechanical consistency. Millionaires in the stock market are not lucky gamblers. They are rule followers. And the most successful investors throughout history share one common trait. They refuse to break a small set of principles, even when emotions are screaming for them to do the opposite. One of the first rules wealthy investors never break is deceptively simple. They never chase the market. Chasing is the emotional reflex of the average trader. A stock suddenly jumps 20% in a single week. News spreads. Social media explodes with screenshots of profits. Retail traders rush in, convinced they have discovered the opportunity of a lifetime. But by the time the crowd arrives, the smart money has already been positioning itself for weeks, sometimes months. The psychology behind chasing is powerful. Humans fear missing out more than they fear losing money. Behavioral finance research repeatedly shows that investors feel the pain of regret more intensely than the pain of actual financial loss. This is why people buy at the top of euphoric rallies. The crowd sees momentum and interprets it as certainty. But experienced market participants see something very different. They see exhaustion. When price accelerates vertically, it often means demand has already been consumed. The buyers who are going to buy have already bought. The result is a fragile structure where even small waves of selling can cause dramatic reversals. Professional investors understand that price movement is not just about numbers on a screen. It is about the balance between supply and demand, and when everyone is already rushing to buy, demand is often close to its limit. This is why disciplined investors prefer something that looks boring to the average trader. They prefer patience. They observe consolidation periods. They watch how a stock behaves after strong moves. They study whether institutions are quietly accumulating shares rather than chasing explosive headlines. A powerful example of this pattern can be seen again and again in market history. Many of the greatest winning stocks did not begin their biggest moves during moments of public excitement. They began quietly, often after long periods of sideways trading when the majority of investors had already lost interest. This quiet accumulation phase is where institutional investors build positions. Hedge funds, pension funds, and large asset managers cannot simply buy millions of shares in one afternoon. Their orders must be spread out over time to avoid moving the market against themselves. As a result, accumulation tends to leave subtle footprints in price action. The market may move within a tight range. Volume may increase slightly on up days. Down days may appear weaker and short. To the untrained eye, this behavior looks random or even boring. But to experienced investors, it is a signal that something important is happening beneath the surface. The difference between amateurs and professionals often comes down to the ability to wait during these quiet periods. Most people want action. They want excitement. They want the feeling that something dramatic is about to happen. But wealth in the stock market is usually built during the moments when nothing appears to be happening. This is the paradox of intelligent investing. The best opportunities rarely feel exciting at the beginning. They feel uncertain. They feel slow. They often feel almost invisible. Millionaire investors train themselves to recognize this difference. They understand that the market moves in cycles of accumulation, expansion, distribution, and decline, and the crowd almost always arrives at the worst possible stage of that cycle. When the public is euphoric, professionals become cautious. When the public becomes fearful, professionals begin to study opportunities again. This discipline requires emotional control that most people never fully develop. The market constantly presents temptations. A sudden rally can make patience feel like a mistake. Watching others post profits online can make waiting feel unbearable. But experienced investors know that reacting emotionally is the fastest way to destroy long-term performance. Instead, they operate with a calm framework. They identify strong companies or strong trends early. They wait for price structures that suggest accumulation, and they enter positions when risk is controlled, not when excitement is at its peak. This rule alone separates many wealthy investors from the majority of market participants. They do not chase what already happened. They position themselves before the crowd even realizes the opportunity exists. Because in the stock market, by the time something feels obvious to everyone, the real opportunity is often already gone. The second rule that millionaires in the stock market refuse to break is the rule of risk control. To the average investor, the market looks like a battlefield where the goal is to win as much money as possible on every trade. But professional investors approach the market from a completely different angle. Their first priority is not profit. Their first priority is survival. This mindset may sound overly cautious, but it is the foundation of long-term wealth in financial markets. The stock market is not a single event. It is a continuous game that unfolds year after year, decade after decade. Anyone can get lucky once. Anyone can experience a short period of explosive gains. But the real challenge is staying in the game long enough for compounding to work its quiet magic. History provides countless examples of brilliant traders who ignored this rule and paid the ultimate price. They were intelligent, informed, and confident. But confidence without risk control eventually becomes arrogance. And arrogance is something the market punishes without hesitation. Millionaire investors understand that every trade contains uncertainty. No matter how strong a company appears, no matter how convincing a chart pattern may look, there is always the possibility that the market will move in the opposite direction. Unexpected news, economic shifts, global conflicts, and institutional repositioning can change price behavior instantly. Because of this uncertainty, disciplined investors never expose themselves to catastrophic loss. They size their positions carefully. They understand that one mistake should never have the power to destroy months or years of progress. A common guideline used by many professionals is simple. Never risk more than a small percentage of total capital on a single position. This might be 1%, 2%, or at most a small fraction of the entire portfolio. At first glance, this approach may appear conservative, even slow, but its long-term impact is enormous. Imagine to investors, the first investor risks a large portion of capital on every trade. When trades go well, the profits look impressive, but when a trade goes wrong, the damage is severe. A single loss of 50% requires a 100% gain just to recover to the starting point. The second investor takes a different path. Losses are kept small and controlled. When a trade fails, it becomes a minor setback rather than a disaster. Capital remains intact, allowing the investor to continue participating in future opportunities. Over time, this discipline creates stability, and stability allows compounding to work uninterrupted. This concept becomes even more powerful when combined with the mathematics of recovery. Small losses are easy to recover from. Large losses create deep holes that become increasingly difficult to escape. For example, a 10% loss requires only an 11% gain to return to the original level. But a 50% loss requires a 100% gain, and a 70% loss requires more than 200% just to break even. Millionaire investors know these numbers intimately. They do not see losses as personal failures. They see them as operating expenses. Every serious participant in the market experiences losing trades. What separates professionals from amateurs is not the absence of losses, but the way those losses are managed. This is why risk management systems are often mechanical. Stop levels are defined before entering a trade. Position sizes are calculated carefully. Emotional reactions are replaced with predefined rules. And perhaps most importantly, Successful investors never average down blindly. Averaging down is one of the most dangerous habits in the stock market. It occurs when investors continue buying more shares of a declining stock in an attempt to reduce their average purchase price. The logic seems appealing at first. If the stock eventually recovers, the investor will appear brilliant. But this strategy assumes that every declining stock will eventually return to previous highs. Market history shows that this assumption is dangerously optimistic. Many companies never recover. Entire industries can disappear. Technology evolves, consumer preferences shift, and economic environments change. A company that once dominated its field can slowly fade into irrelevance. Professional investors recognize this reality. When price behavior proves them wrong, they exit the position and preserve capital. Their ego does not demand that they be correct on every trade. Instead, they accept that being wrong is part of the process. This humility is surprisingly rare in financial markets. Many investors attach their identity to their positions. Selling at a loss feels like admitting failure. But experienced traders understand that stubbornness is far more expensive than humility. Every dollar preserved during a mistake becomes fuel for the next opportunity. And opportunities in the stock market never truly disappear. They simply rotate from one sector to another, from one trend to the next. Technology leads during one decade. Energy surges during another. New industries emerge while older ones fade away. The investor who protects capital remains flexible enough to participate in these evolving cycles. In this way, risk management becomes more than just a defensive strategy. It becomes a powerful offensive advantage. Because the investor who survives every storm eventually has the capital, the confidence, and the experience to capture the next great wave when it finally arrives. Part 3. The third rule that millionaires in the stock market never break is the rule of patience with winners. Most investors believe the biggest mistake in the market is losing money. In reality, the most expensive mistake is often selling a great investment too early. This behavior is deeply rooted in human psychology. When a stock begins to rise and profits appear on the screen, the brain reacts immediately. There is relief, excitement, and a sudden urge to lock in the gain before the market can take it away. The investor feels smart, successful, and temporarily in control of uncertainty. But this instinct often works directly against long-term wealth creation. The greatest fortunes in the stock market were rarely built from hundreds of small, quick trades. They were built from a handful of extraordinary trends that were allowed to grow over time. The market rewards those who can identify strength early and then remain patient enough to stay with the trend as it develops. Consider how large institutional investors operate. Hedge funds, pension funds, and asset managers controlling billions of dollars cannot move in and out of positions every few days. Their strategy is built around identifying long-term themes and positioning themselves early. When they find a company with strong earnings growth, expanding market share, and increasing institutional interest, they do not think in terms of days or weeks. They think in terms of years. This difference in time horizon changes everything. Retail investors often look at the market through a short lens. A 5% move feels significant. A 10% gain feels like a victory. But in reality, the biggest market leaders frequently rise hundreds of percent over multi-year trends. These massive moves are invisible to investors who exit at the first sign of profit. History offers endless examples of this phenomenon. Many of the most dominant companies in the market began as relatively small opportunities that only revealed their full potential over time. Investors who had the discipline to hold through volatility were rewarded with returns that seemed almost impossible at the beginning. Yet holding a winning stock is emotionally more difficult than most people realize. When prices rise steadily, investors become nervous about giving back profits. When the stock pulls back temporarily, fear begins to grow. News headlines change tone. Analysts debate whether the rally is over. The investor who once felt confident now begins to question the decision to stay invested. This psychological pressure leads many people to sell strong positions during normal market corrections. What they do not realize is that trends almost never move in straight lines. Even the strongest companies experience temporary declines along the way. These pullbacks are not always signs of weakness. In many cases, they are simply the market's way of shaking out impatient investors before the next phase of the trend begins. Millionaire investors understand this rhythm. They study the difference between normal volatility and genuine structural weakness. Instead of reacting to every small fluctuation, they observe broader patterns. That is the company still growing revenue? Are institutions still accumulating shares? Is the overall trend structure still intact? If the answers remain positive, they often choose patience over panic. This patience is not passive. It is disciplined observation. Professional investors continually evaluate their positions, but they avoid emotional reactions to short-term noise. Another important factor behind this rule is the mathematics of compounding. When a stock doubles, the impact on a portfolio becomes significant. When it triples or quadruples, the effect becomes transformative. A single exceptional investment can sometimes outperform dozens of smaller trades combined. But this only happens when the investor allows time for the trend to fully develop. Many successful investors have openly admitted that their greatest profits came from a very small number of positions that were held far longer than originally planned. These investments grew into major winners because the underlying companies continued expanding while the investors resisted the temptation to exit prematurely. In contrast, constantly jumping in and out of the market creates friction. Transaction costs accumulate. Taxes reduce gains. Emotional stress increases. And most importantly, the investor often misses the largest portion of a trend while searching for the next opportunity. Patience transforms the market experience. Instead of constantly chasing movement, the investor learns to recognize when a strong position deserves time to mature. This does not mean holding blindly forever. Every trend eventually ends. Companies face competition, industries evolve, and market conditions change. But millionaire investors understand that selling should be based on evidence of real deterioration, not temporary discomfort. In this way, patience becomes a strategic advantage. The investor who can sit calmly through normal volatility gains access to something rare in financial markets: the ability to participate in truly large trends. And those large trends are where extraordinary wealth is created. Because in the end, the stock market does not reward the investor who trades the most. It rewards the investor who recognizes strength early, manages risk intelligently, and then has the patience to let success grow far beyond the limits of short-term thinking.